Welcome to Tax Sale Insiders, the latest from Tax Sale Resources, bringing you information about tax sales from experts in the industry. TSR has interviewed a variety of industry leaders across the country, including Stephen Morrell of Juristine in Louisiana, Maureen Zink of Carlisle Law in Ohio, John Stanko of Stanko McCarthy Law Group in Illinois, and many, many more. The following is just a small snippet of a longer, in-depth interview with one of these leading industry experts. We interviewed Mark Manoil of Manoil Kime PLC based in Phoenix, Arizona. In this clip, Mark shares insight into some differences between how counties are selling the tax liens, which may have long-term consequences. Mark's legislative knowledge and extensive experience in this industry shines through, so stay tuned.
But in these last few years, we've seen developments like a set of laws be adopted that applies only in Maricopa County. Half a dozen laws that are specific to Maricopa County and separate it from all the other 14 counties. So that another caution, don't think that your understanding of how things work in one county necessarily translates to other counties. You have to sort of go through the learning curve in each new county where you invest, to make sure that you understand how they do it, because there are local variations in things that you would think are not really open to diverse interpretations.
Yeah, it's interesting because you see that, I've seen that or heard of it in multiple states now, where the big metro areas adopt a slightly different rule set as opposed to the rest of the state. You see that in Illinois with Cook County, and
sure.
In Missouri, I talked to a gentleman and he was explaining how the two major metro areas in Missouri each has their own slightly different rules. So as that population seems to grow, that's when they decide, okay, we need to play by different rules for one reason or another. So it's interesting.
Well, I'm sorry, may I pursue that point with you for just a little bit more? Well, the Maricopa County is almost 2/3 of the population and the wealth of the state. And so the county treasurer, or county treasurer's office, I should say, sort of has outsized weight at the legislature. And when it's politicized, as I think it has been for at least the last 4 or 5 years, it can drive some kind of bad results, which is what happened. And the half dozen laws for Maricopa County, I think, really create some disincentives for tax investors in Maricopa County. And part of it, I think, is tied to the ideology of the incumbents during this period. Part of it may be ascribed to their ignorance about how the system actually works or is designed to work. May just be open hostility to that. And I want to give you an example for your audience too. In Maricopa County, one of these laws required that every tax year be sold as a separate tax certificate, rather than the existing practice, which remains in the other counties, where if you buy a tax lien, you have the first right to add on the next delinquent year to the certificate, endorse additional taxes, you pay the extra money, the next year's taxes, and the treasurer adds that to your tax certificate. And so during that 3-year hold time, you're paying additional year's taxes, right?
Right.
So at the end of the 3-year period, you have a tax lien that has 3 or 4 years of taxes on it. And that's what you go to the foreclosure action with. Well, in Maricopa County, because each year is mandated to be a separate certificate, means that the foreclosability of each year is tied to the sale date of that separate certificate. So if you buy a lien in February, you can you have the first right to buy the next certificate. You still have that subtax right, if you will,
Right.
which arises June 1st. You can buy the next delinquent year, but it's a separate certificate. So because it's a separate certificate, that means that second delinquent year won't be foreclosable until 3 years from that date that you paid for that. So it won't go to the February date. You have to wait until 3 years has passed on the second one for both of them to have become foreclosable. And likewise, if you buy another delinquent year a year later in June the following year, you're going to have to wait for 3 years from that for all three of your years to be foreclosable at the same time. So by only being able to, if you want to foreclose as soon as possible, which I would think the public policy would actually favor, because you want to return the properties to the active role, either by getting them current on their back taxes or changing the ownership to somebody who will pay the taxes. They have actually gone in the other direction by giving you an incentive to wait longer to start your foreclosure action, or engage in a kicking the can down the road operation where you've constantly are financing the back taxes for the delinquent property owner, but only able to bring action to enforce, a portion of what you've paid out in the back taxes. If you go off the 3 year dates, it just doesn't make sense to me.